My oh my, Santa Claus appears to be coming to town here in the United States stock markets. Last 2 days have been epic rips higher after, of course, struggling for a bit in recent weeks. So we've had a bit of a shift of optimism on Wall Street. Today was actually the second best day of the entire last year. The last time we had a day stronger than a 2% move to the upside like we saw in the S&P 500 today was back in March. So, 9-10 months ago or whatever it was. So this has been a very impressive 2-day rally here, and it's been enough to actually change the posture on a number of charts. So we'll get into all of that. We'll take a look at some of the bigger movers of the day. And then I wanted to talk about our trade application example where I wanted to focus on a bullish swing trade to the upside with an alternative energy company. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee, and it's December 7th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel if you haven't done so already, and then make sure you're also signed up for our email distribution list. You can find a link to that in our description area underneath the YouTube video. In addition to that, we're heavy users of Twitter. Feel free to follow me. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these market outlook related tweets that we post. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see embedded in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got my heat map here for the S&P 500, and you can see it was quite the tidal wave of green that we experienced here today. Importantly, what kind of stands out to me is where we've seen some of the biggest amounts of kind of light green colors is in some of the more speculative and growth-oriented areas of the market. So for instance, you do see that NVIDIA, as just one example, was up 8% today. Of course, that's become one of the most legendary growth stocks of the past decade or so. You also see lots of these other tech-heavy and mega cap status kind of growth names doing quite well, whether it's Microsoft up almost 3%, Apple up just over 3%. We had Alphabet up basically 3%. There's Facebook/Meta up almost 2%. We had Amazon up nearly 3%, and Tesla was up over 4%. You also have some smaller players within the technology area like ServiceNow and Fortinet. We've got Applied Materials, NXPI and Microchip and some of the other semiconductor players. But the important part is those mega cap giants right there, those larger squares and rectangles that you see, of course, dominate the markets these days. To a greater degree than they have in other eras. Many of you have heard of the statistics about the top 5 stocks in the United States controlling much of the trading activity within the indexes these days because of the market cap weighted nature of something like the S&P 500 and the Nasdaq composite. So today was a day for the giants, also a day for the growth/innovative companies. There's been a lot more chatter these days about Cathie Wood and the ARK funds, where she concentrates on disruptive and growth-oriented names, and they've been absolutely trounced in the last month or so. Today was a massive rebound for those types of companies. I see some of the names that she might have an interest in off to the right-hand side as we look at some of those healthcare names. Intuitive Surgical, Align Technologies, and Dexcom. Those are kind of growth-oriented healthcare companies. You could even throw in Moderna and Illumina in there as kind of a diagnostics company, in addition to, of course, the vaccine manufacturer there. But that's a good sign when we see those types of kind of up-and-coming growth-oriented names taking a leadership role like we saw today. Really, as we're looking at this, we only see a couple of rough patches out there. I would say that the consumer staples kind of sat out the rally here today, as you see a few more of those maroon and red squares in that general vicinity. You also saw some of those telecom players, whether it's AT&T, Verizon, Comcast, etc. They sat out today's rally, and then a couple of those big pharma kind of old school giants like your Eli Lilly's and your Merck sitting things out there as well. But for the most part, you can see this is a very positive sign for the market as we see lots and lots of green in the risk-taking areas of the market, telling us that this bull market is still alive and well, that the bears didn't completely put them out of their misery, and the bulls do still have a lot of fight and a lot of life left in them during this traditionally bullish time of year when we do start to anticipate that Santa Claus rally. So we'll keep our eyes on the situation as we always do moving forward, but I would say that the last 2 days were incredibly important to this market's prospects to closing the year somewhat strong when that was really called into question just as recently as last week. So good on you, bulls, for getting out there and showing up for the big game. Part of it I think is maybe a little bit less consternation around this variant, the Omicron variant. I think Dr. Fauci came out today and said he does not anticipate it to be any worse than the Delta variant, and I think that kind of appeased some of the market participants here today. Let's take a look at some more charts. Wanted to kind of highlight this chart as I traditionally do whenever we have a move of over 1% within the S&P 500. For those of you that are following along at home and are premium members of Market Scholars, this is chart 6D. I got a question on that via email the other day when looking at this histogram. I know sometimes it's hard to see those labels up there, and sometimes we have some different edited versions of charts and things like that. But this is the main version that we have for 6D, and this helps us understand if we have had more aggressive trading, both up and down more recently, or whether we've had a quiet period. And I would definitely categorize the most recent couple of weeks as a more aggressive trading environment. You can see how widely these bands are swinging both up and down, whether you're looking at this big meltdown type of a day back here where the market was down well more than 2%. Remember how you read this is there's this zero black line here on the histogram in the middle that represents a 0% move for a day, which of course would be pretty rare. So when you see a big red candle like this, what that means is that was a big down day for the S&P 500, and when it goes down below this orange line down here, that means it was down more than 2% that particular day. So we had that day that was pretty ugly, and then we also had a handful of other 1% down moves there. But equally as important is we also have had some really big up days, and that's what today represented. As mentioned in the intro, you can see now a little bit better visually how it kind of fares or shapes up against all of the other trading days of the past year. Remember, this chart by default is a 1 year, 1 day chart. We can set it up with different time periods, but unless we tell you otherwise, just assume we are looking at 1 year's worth of data on this particular chart. And so we can see right here that today's candle, this green one that is stretching up and above the upper orange band, means that it was up more than 2% here on the day. And the only other time we can make that claim is as we kind of cross all the way over to the left-hand side here. You can see it was this day and this day alone. March 1st was the only other day in the last 12 months that was a stronger performance than what we just experienced here today. And like I mentioned before, some of the other areas like the innovative, disruptive, growth-oriented areas that, Kathy Wood and others focus on, you saw an even more robust rally with a lot of those. Now, granted, a lot of them have been down 20, 25, 30% recently, so even when they bounce back 10 to 15% today, they still got work to do. But it is at least a sign that risk taking is still alive. It's out there. People are interested in purchasing merchandise when the price is right. And perhaps this great resetting of price that a lot of those types of companies have had in the last month or so have opened up the eyes of more value-oriented investors, or those at least that prefer a lower price and felt like things had kind of gotten out of control to the upside previously. So, a good day, all things considered. Some of you might have heard the rhyme before that when the VIX is high, it's time to buy. And I think that does describe what we've seen here in the last couple of days as well. When I was with you last on Thursday in this Market Outlook presentation, we were talking about the VIX and how it was basically at its highest level over the past year, right here on that purple line down below. And I was talking about how there was a lot more chirping and chattering about people who expressed an interest in hedging their portfolios. And the idea that you want to hedge your portfolio after the horse has already left the barn usually is a costly mistake. Folks that didn't know that previously perhaps have learned that lesson in the last 2 days, because as you can see here, the VIX has fallen from about 31 just here on Friday all the way back down here to 22 as it stands in real time. Now, we're still not down to the ultimate lows that we have been used to trading at for much of the last 12 months, which is clearly below 20. Again, we're at 22 right now, but we are back in that vicinity. And so on days like Friday, some of you that follow me on Twitter might have seen my tweet on Friday when I said it smells like a put selling day. And there's that classic gif of that old movie where the guy says, love the smell of napalm in the morning, because the markets were getting destroyed. They were getting bombed out on Friday morning. And those are the types of days I like to sell puts. I want to sell puts on stocks that I want to own at lower prices when everybody else is highly concerned, and the VIX means that the premiums that I'm receiving up front are very juicy. Now, obviously, that's not a guarantee that will always work, but in general, you should pick and choose when you want to be a put seller. And the better days I've found throughout history is when everybody else is highly concerned about stocks and the VIX has skyrocketed higher. Because like I mentioned to you last week in this video, the VIX has a reputation for spiking up out of the blue, sometimes in unpredictable ways for unpredictable reasons, news stories that we wouldn't have anticipated, sort of a thing. But they also have the reputation for equally as quickly unwinding a high VIX situation. That is the nature of a longer-term bullish market that we've found ourselves in for the last 12, 13 years. You have these random spikes out of nowhere out of the VIX, and then they're equally as quickly unwound. So you've got to act fairly quickly when you want to be the seller of premium. Some of you might even want to set yourself an alert or do something to help yourself remind yourself that when the VIX gets to 30, like we saw here late last week, those are oftentimes times to be brave and go counter trend, do something bullish like selling a put where you get much better strike opportunities, plus you have much juicier premiums up front, because then if you do have a 1-2 day punch like we've seen yesterday and today where stocks skyrocket to the upside and the VIX collapses lower, you get a double benefit there. The falling VIX is improving your sold put situation, and of course the rising stock prices mean that the company is rising up and away from where your risk level is on that sold strike price. So anyway, some interesting lessons, to say the least, have been learned over the past week or so. Now, as you can see, we're not quite to new all-time highs yet, so while the last 2 days were very robust, it is certainly possible that we do have some resistance up in this area. I like our chances here, I'll say that, because of how aggressive these 2 days have been. But you could also understand folks that might be a little bit concerned that we kind of flatlined up here in the S&P 500 for a couple of weeks without showing much progress, making you wonder if there is some big market sellers up in that general vicinity, and whether that will be an excuse by technicians here in the next day or so to perhaps put an end to this short-term rally. Again, I kind of like the prospects, given the aggressive nature of the last 2 days, that there is a lot of momentum, a lot of oomph behind this move, where I think there's a pretty decent chance we get up and through all-time highs here by the end of this year. Remember, we're already a week into December, so there's not many trading days left, but I think there's a pretty decent chance we can print a brand new all-time high here in calendar year 2021, when just a week or so ago, there was a lot of folks that felt like that was probably not going to be in the cards. And so a major change in optimism that we've seen flowing into the markets here the last couple of days. From a market breadth perspective, I wanted to point out as well that in the S&P 500 today, we had 433 stocks that were higher, 68 that were lower. So excellent breadth across the board. We probably recognized that when we were looking at the heat map a moment ago, but just to put a ribbon on it, we had an 85% up day type of breadth market that we had here today, right, in terms of participation within a broad index like the S&P 500, which just saw a blurb a moment ago that Kansas City Southern, the railroad company, is going to be replaced by EPAM, which is kind of a payments provider and back-end technology offering or services type of a company. So we will have perhaps some changes within different indices and different pools of investment. I was sharing with my dividend growth investing class today that Leggett & Platt is going to be removed out of the S&P 500 as well. And Leggett & Platt is not a well-known stock to very many people, except for those of us that consider ourselves dividend growth investors. It is one of the dividend aristocrat companies that sometimes you guys hear me discuss. And a lot of times what you find is that companies fall off of the dividend aristocrat list because they have to cut their dividend. Remember, to get on the list, you have to have 25 years in a row of increases. So it's not an easy thing to accomplish. But sometimes what gets left out is that you also have to be part of the S&P 500. So Leggett & Platt is a rare example of a company that will likely fall out of the dividend aristocrat list in January when that committee gets together, not because they cut their dividend, but because they're no longer part of the S&P 500. Something similar happened a few years back to Bemis Corp, for those of you that might remember that particular situation. So anyway, be aware that this time of year we're seeing a lot of different changes in market caps, and we're trying to kind of get arranged and get kind of settled with year-end kind of maneuvering and things like that, and you might end up seeing a few more of those index change announcements. So stay tuned on that, and of course follow my Twitter feed if you're interested in particularly that dividend growth type of information. All right, let's go ahead and take a look at our forward grid now that we use for the market forecast technical indicator, and that's chart 4B for those of you following along at home with your own charting package. As you can see, today was an important one. 3 out of these 4 indices in front of us now have bullish postures again. Remember, that was not the case as recently as yesterday. So when you have a back-to-back impressive rally like we've had both yesterday and today, it, of course, is going to impact the technical analysis. Remember, all technical analysis is lagging to one degree or another because technical analysis is simply the analysis of prior price and volume candles. That's all it is. It's just different ways to go about evaluating that, and that's why there's so many different technical indicators out there. But the point is, pretty much all technical indicators are using previous data to plot their indicator. And in this particular case, we don't typically see a quick reversal unless we have aggressive movements. And I would define what has happened to the upside the last 2 days as aggressive movements. They were not normal days. And so as you can see here, the S&P 500 was up 2.07% today. Notice that took you from being below the 30-day moving average to being easily above it. It didn't even stop to ask for directions, right? Sometimes you see a stock or an index go up to the moving average and then kind of have that hesitation where you just don't know if it's going to burst through or not. This one, we didn't have any question whatsoever about that. S&P 500 burst straight through it and just kept on cruising. Closed near the highs of the session. And in doing so, changed our background color from dark pink to light green, and the reason for that is not necessarily because it bounced above the moving average. That's just merely coincidental, and that's also supportive of the bullish conversation. But the reason that the background color changed is because that green intermediate line on the market forecast technical indicator that you can find on Thinkorswim and other TD Ameritrade products changed from going lower, like we saw for the last couple of weeks, to now going higher after today. There was a reversal that took place on that green intermediate line, where we were heading towards that lower reversal zone at 20, but we reversed course and are now heading higher. So that background colored shift to light green is accounting for that. And that light green, as a reminder to those of you that might be newer, is what we would consider to be weakly bullish. So we're not to the point of saying it's strongly bullish yet, but it could very well get there. If we burst out to new all-time highs in the coming days or weeks, we would likely get there. But what it needs from the indicator's perspective officially is for that green line to get up and above the chart's 50th percentile. Right now it's at the 34th percentile and rising. So again, it is considered weakly bullish, but we'd like to see it get up above 50, and that way we can start calling it a strongly bullish market rally again, just like we did during this chunk of time over here where we had some really nice gains there in the month of October. So good sign there on the S&P 500. The other thing I would point out that is a change today from where things sat last week is notice the moving average is green. Yesterday it was yellow. So a green moving average is telling us that price is now above a rising moving average. Yesterday it was yellow because the moving average was already rising, but price was still below it. The day before that it was red because price was below a falling moving average. So now we're kind of clicking back into gear here where both price is doing well and the moving average, that lagging indicator over the last 30 trading sessions, is also supportive of that bullish price action. So very good sign that we have right there. Speaking of which, let's talk about the Nasdaq here because it's awfully similar in that we have now reverted from a bearish posture to a bullish posture as of today because of the big reversal. Notice that the Nasdaq was up 3.03%, and that was our leader for the day. Again, reiterating that today was a day for the growth stocks and the innovative and disruptive types of companies. Many of those are housed, of course, in the Nasdaq composite. So a huge day for the Nasdaq, up 3%, and of course that was enough to turn that posture from bearish back to bullish here as well. What I would say, and also another commonality is that it does have that green moving average, just like the S&P 500, where price is now slightly above that rising moving average. Why I think that the S&P 500 appears to be a bit stronger to my eye right now is because with the S&P 500, it was able to keep motoring higher through that moving average. The Nasdaq only got basically up to it and closed just a hair above it. So it does call into question whether you're going to have a little bit of resistance there at that moving average, tomorrow or the next day or what have you. You'll also notice that the prior high for the S&P 500 does not appear to be all that far away, whereas you've got a little bit more work to do there on the Nasdaq composite. I would also note that that green line, look at how you can actually see the V type of recovery there in that green line on the S&P 500 down below. But with the Nasdaq, technically, yes, it did reverse and is now rising. It's at 28th percentile and rising. But notice that the reversal does not give us that V-shaped impression. It's more of a like a hockey stick there or something, where it's this is the handle of the hockey stick, and that's kind of the head that you would hit the puck with down below there. So in other words, it's not a V-shape recovery strongly higher. It's more of a modest recovery higher at this point. Not to say that it couldn't turn into that eventually, but right now it just seems like the Nasdaq had so much extra damage done to it during this pullback in the last month that despite having a really aggressive day-to-day, from a trending perspective, it does seem that the S&P 500 might be slightly better set up for those types of trades. Now onto the charts on the right-hand side here, and they're not nearly as impressive in my eyes as what we see with the S&P 500 and the Nasdaq composite. The good news is for the Dow Jones Industrial Average, which was up 1.4% today. Remember, that's your big blue chip, kind of mega cap, cash flowing types of businesses out there, right? Your JP Morgans and your Caterpillars, not the most exciting businesses on the planet, but solid businesses nonetheless. Oftentimes what you find is that they do not move as aggressively as something like Nvidia, right? Both on the upside and the downside. So when we have big upside days like this, it's not a surprise to see the Dow Jones kind of lagging to a degree. On the flip side, they usually don't go down as aggressively on the really bad days either. So you kind of have to take that for what it's worth, and you have that little bit of a balance there. Anyway, with the Dow Jones Industrial Average, it's not that the 1.4% bounce today was overly disappointing to me. It's kind of how it looks on its moving average. Notice that the S&P 500 really just kind of flatlined with its 30-day moving average over the past week. And you could probably get away with saying the same thing for the Nasdaq composite. Yet when you look at the Dow Jones Industrial Average and the Russell 2000, you have a very distinct and clear pathway lower on those moving averages there. So I think that there is a little bit more of a technical challenge that we have to get through with those two charts. The good news is if the S&P 500 and the Nasdaq can keep on motoring, I think that it has a good chance of bringing the others up with it, kicking and screaming, whether they want to or not. But if you're just looking at this on a standalone basis like we are at this moment, then you kind of recognize that, yes, it's good that we saw this back-to-back rally and we've got bullish progress on the chart to the point where we now have a weekly bullish intermediate posture like we did with the other two. But we also recognize that this one also fell out of bed pretty violently, really distorted that 30-day moving average, and now you might have some folks trying to take some chips off the table there if they're satisfied with that kind of dead cat bounce that we had here more recently. Dow Jones has a long ways to go as well, similar to the Nasdaq, before getting to its old highs. So my guess right now is that if any of these four indices hit a new high in calendar year 2021, which I do anticipate personally, that it will be the S&P 500 that gets us there first. Now down below here on the Russell 2000, similar to the Dow Jones Industrial Average, I'm not overly enthusiastic with what I see there. Yes, it's great that it was up 2.28% today, but notice that this is the only one of the four that we're looking at here that continues to have a strongly bearish intermediate posture. Notice the background color is still that dark pink shading there. And the reason for that is while the green line is now heading higher like all of the other charts, notice that the green line is at 15 and rising. And because that number is still below the 20th percentile, it means that that's still in the lower reversal zone. And we do have kind of a grace period both in the lower reversal zone and upper reversal zone where we want to see it emerge out of those reversal zones before we're willing to change the posture on it. So it's probably going to get there, but when it does, it'll probably still be on the underside of that falling 30-day moving average. So that's why out of all these four charts, you still probably have the most hesitations around what you're seeing there with the Russell 2000. Now the good news is the small caps tend to do better at year end and into the beginning of the new year. So I think from a seasonality perspective, that might help the cause. But just from a purely technical analysis perspective, notice the big gap that we have between where we're trading right now and that downtrending 30-day moving average. Notice all three other charts literally were touching their 30-day moving average today, yet we still have a long ways to go on the Russell 2000. Trading has been wild and aggressive on the Russell 2000, so I'm not here to say it can't happen. I'm just here to say that the odds are not nearly as good for a really pretty looking trend trading chart on the Russell 2000 as is possible on the other charts there. You'll notice that the Russell 2000 actually had an above average trading range today compared to its average true range with that orange label up at the top of the chart there. So a good 2% plus day for the Russell 2000, but because it had been blitzed so badly to the point where, remember, that was our only one that actually gave us an oversold cluster signal that occurred on December 1st. All of these other charts got hit as well, but not nearly had done as much damage as what was done on the Russell 2000 to the point where you actually got an oversold cluster signal. So we shouldn't be surprised to see this kind of counter trend move that we've had right here, knowing that we had that oversold cluster signal. I think the disappointing part is that it still has not been able to manage to get up to that moving average like all the rest of the charts. So still have some ongoing concerns, I guess you would say, with the Russell 2000 there compared to the others. Let's take a quick peek over here at the internet. I always like to get a chance to say thank you for those of you that help support this free YouTube video that David and I try to deliver to you as often as possible. You can see that the last time I did the video, 98 of you came out of the woodwork and stepped up to do the video, and I really appreciate each and every 98 of you. I like to remind folks that it takes 3 hours out of our day to do this video that we don't get paid a single cent to do. And so we have to have the motivation in order to commit that much time out of our busy days, where we, of course, prioritize supporting our premium members, where we, of course, are teaching our normal trading rooms, like I taught my dividend growth investing trading room today for a couple of hours. David taught his directional option strategies class today. So they take priority. Secondarily, these free YouTube videos are out there if we have the time. And like I always tell you, as long as we're up and over 100 likes on Twitter, I'm going to prioritize doing the video. Now, obviously, today we were not up and over 100 likes, yet I am still doing the video, because it's not as though I won't do the video if we don't get to 100 likes. It just really depends on what my schedule looks like. So do your best to click like. That's all we ask out of you. It only takes you 5 seconds and doesn't cost you a thing. And that will help send the message that you want us to continue to do these videos as often as possible. I've got a few things going on later on in this week. Unfortunately, my dryer broke down, so I got to get a repairman out here. And at this point, I'm not sure if I'll be able to do that on Thursday or Friday, but just as an example, if I'm up and over 100 likes, by the time I look at the information on Thursday, then I'm going to prioritize doing that. And if I have to cancel that appointment, if it's set during that time, I will. On the other hand, naturally, I wouldn't want to cancel an appointment if there's not a whole lot of enthusiasm to help support these videos. So do your best on that point. We're really happy with your guys' ability to do that, and we're thankful for you being willing to spread the word about market scholars out there. Also, a quick heads up that I posted the dividend increase announcements from last month. I did that over the weekend. I like to remind folks, especially in this particular presentation, because we do operate kind of a freemium model, as they call it, business model, as mentioned before this video. We don't make a single cent on doing. With our premium trading rooms, we do make money there, naturally. So there are a few things that we do for free, and then there are a lot of other things that we do just for our paying members. This happens to be one of those free things as well. So for those of you that are interested in dividend growth investing, you can come up here to our website at marketscholars.com and hover over the blog mega menu, and then click on dividend growth investing. And then once per month, you'll see kind of an accumulation of all those stocks that have been raising their dividends recently, and whether they're impressive moves or whether they're more, kind of token increases, as I call them, and some of the yield numbers and different things like that. We actually reviewed this yesterday afternoon in my options for long-term investors class. So for those of you that are plus and premium members and you want to hear my take and my interpretation and analysis on some of these that I found to be more impressive than others, and perhaps some of the stocks that might be available to purchase at a value right now, feel free to watch my recording from yesterday afternoon. All right, let's go ahead and get back on track with some more analysis on Think or Swim. And I'm going to take a look here at our asset class 12 grid. This is chart 5A. Now, interest rates have been a big talking point in this market recently, as you guys are well aware, because David and I talk about them regularly here with you as well. And today was yet another kind of big day for interest rates. In this case, it was the second straight day of interest rates rising. Notice that we rose pretty well there, about 46 basis points on the 10-year Treasury yield, and we ended at 1.48%. Now, that's still below where we were trading, of course, a month or two ago, but it is aggressively off of the lows of interest rates that we saw just on Friday. Remember, when interest rates go up, all else being equal, it's usually a good sign for risk appetite. Oftentimes, interest rates go up in anticipation of a strong economy where the Fed may need to be less dovish, as an example, and start either tapering or hiking interest rates eventually. And so I think sometimes people are fearful of rising interest rates, but in a lot of ways, it's actually a more promising sign for the overall economy. So just understand that it can cause volatility, and the markets are there to serve you, not the other way around. And as we mention regularly, there's a lot of interest rate sensitivity in areas like financials that tend to benefit from rising interest rates, but also utilities and REITs that sometimes are on the opposite side of that coin. And when there's a lot of volatility in the marketplace, you can look for opportunities where maybe babies have been thrown out with the bathwater or what have you. So it's good to see that interest rates have had a nice snapback rally the last couple of days right alongside the U.S. stock markets. The bad news is you can see we still have clearly a carved out pattern of lower highs and lower lows on the TNX, which tracks the 10-year Treasury yield. So I don't think we're reversing course and all of a sudden in an uptrend here on interest rates. I think it's kind of just correcting the overly aggressive selling off of rates in recent weeks and trying to find a right fit for where it belongs right now. So remember, the opposite is often true with bonds. Fixed income prices tend to move inversely to the yields and interest rates themselves. And so no surprise that when we look at the long-term U.S. Treasuries, these are usually 20, 30-year bonds, so it's not an identical inverse relationship to TNX, but it's about as close as we can get, at least from a liquid perspective. And you can see here that TLT, of course, did drop the last 2 days. It was down 0.81% today as bond prices sold off and money rotated into the stock market and out of the bond market. Despite the 2-day sell-off, notice the background color of the TLT chart remains dark green, telling us that we still have a strongly bullish intermediate market forecast posture. And I think that I would confirm that just visually. In other words, yes, we've had a couple of pullback days, but I don't think this uptrend has been broken yet. Maybe it will be eventually, but right now, I think you kind of got to give it the benefit of the doubt. You still have that strongly bullish posture, and you still have a rising 30-day moving average. So we'll see how that plays out going forward. But today was a down day for bonds, an up day for interest rates. You did see a pretty flat day on the U.S. dollar, which remains in its own robust uptrend. And you didn't really have much movement out of gold, but be aware, last week I mentioned the oversold cluster signal in GLD, which was the first one since going back here to September. We have had a bounce from that level. And again, that's kind of what they're designed to do, just like we saw over here with oil. We had that oversold cluster signal, that green dot on the chart, and we had this reversion to the mean since then. Doesn't always happen, but more times than not, that can happen, and you can have some nice counter trend trades as a result. So the move on gold hasn't been nearly as robust as what we've seen there with oil, but it has at least kind of started to wear off some of those oversold conditions, and I think gold remains a very interesting iron condor candidate as it continues to be in the middle of that three-month range, just like I've been kind of chirping about here with you guys for the last 2 or 3 weeks, right? So for those of you that did the iron condor on gold a couple of weeks ago, you likely have some gains in your account as a result of that, because we really haven't gone anywhere with GLD in the last couple of weeks. We had a mini move lower to that oversold cluster and then a reversion to the mean right back to where we were trading just a couple of weeks ago. So a whole lot of nothing in effect, there for GLD, which is exactly what you're looking for when you're doing neutral trades like selling iron condors. Up at the top, when we're looking at our stock markets, notice that EFA had a really impressive day. It actually outperformed the United States. Remember, EFA is going to be a lot of your European, Japanese, Australian types of companies, the developed foreign world, as opposed to over here with EEM, which is more of your China, India, Brazil, Russia, that sort of thing, where you've got your kind of developing markets still. So today was a day where the developed foreign markets outperformed the developing foreign markets there. They both did well, but we had a much stronger performance there out of EFA. Now notice that both of those foreign charts remain below their falling 30-day moving averages, which is not the case for the U.S. market, as we discussed earlier. So the foreign markets do have a bit of catch-up to do. I was referencing William the Refrigerator Perry today in my dividend growth investing class and comparing that to the U.S. markets recently. So if you're wondering what in the world that analogy is about, feel free to check out the dividend growth investing recording from earlier today. But some of you might recall that name. Those of you that are a little bit younger younger or perhaps not interested in the NFL might not know that name, but surely anybody that was watching football back in the 1980s will know the refrigerator, because that's how he was built. He looked like a refrigerator. Anyway, the U.S. markets have been a blessing for investors over recent years, and that continues to be the case here right now. As we're back above the rising moving average in the United States, and the other areas of the world, we're still struggling with that possibility at this moment in time. When it comes to our sectors here now, our sectors are going to be, hang on just a second, there we go. 5C is the chart for our sectors. And we've got good news here. Remember, it wasn't so long ago, it was bloodshed across the board. Today, we've got just one pink chart on the board, and that is communications. That continues to be our laggard. Remember, that one's been at the bottom of the sector selector here more recently as well. But we've had a lot of selling in not only the telecom names that make up the communication, but a lot of the social media names that make up communications there, as well as even some of the media players, Comcast and Disney and some of those kind of older school media companies have been struggling lately as well. So communications has been out of favor without a doubt during this last month plus, whereas a lot of the other sectors that were out of favor a few weeks ago have swung back into favor. So look at all those bounces all over the place. It was a strong day out there. In fact, all 11 of these sectors were actually up today. So the intermediate posture on communications is still bearish, but even it was up over 1% today. We had some really strong movers out there. Take a look at technology, up 3.5% here today. And remember, that is market cap weighted, so that's even more impressive when we're talking about the impact of Apple and Microsoft and some of those others. And all of a sudden, XLK is right up here at new all-time closing highs. We're not quite to an intraday high that we touched here on November 22nd, but where we closed was higher than where we closed that day. So a really, really impressive day there for technology, in addition to a lot of these other charts. Also wanted to point out real briefly here, utilities. Notice the nice bounce higher. We've actually been higher 1, 2, 3, 4, 5 days in a row there with utilities. After starting that rally a bit below that moving average, we're back up above it. I'm pointing that out specifically, and note that both technology and utilities have a strongly bullish posture according to the market forecast, in addition to real estate off to the right hand side here. But reason I'm pointing out utilities is because it then works its way into my trade application example that I wanted to show you for the day. Now, a reminder that this trade has already been done. I've already sent out all of the notifications and trade details via our Telegram trade alerts app that we offer to our premium members. So that gives those folks an opportunity to see what David and I have in store later on in the night when we're doing our market outlook free video for everybody else. And so this trade has already been done. The idea behind the trade is simply it's a bounce bullish swing trade, and you can see this particular company is ticker symbol CWEN. It's not all that well known of a company. The company's name is Clearway Energy, but really it's a utility stock, but one of the up-and-coming kind of alternative energy utility companies that are out there. So it's not a company that is as well known as, like Southern Company or NextEra Energy or Duke Energy or something like that. This is a relative small fry within the business. But as you can see here on this chart, it's done reasonably well over the last 3 months. It's actually up about 18% over that time period, easily outperforming the S&P 500 with that dotted gold line down below. You can see we kind of got a little bit ahead of our skis here in this big move from mid-October to topping out here in mid to late November, and then we had this give back time period like we saw with a lot of other companies. Now in this particular case, it didn't really ruin the uptrend. It just kind of wore off some of the overheated conditions that we had in this chart, and we pulled back somewhat gently to this rising 30-day moving average, where for the last couple of days before today, we were testing those levels, right? We were testing the depths to see if it wanted to crash through that moving average or whether it wanted to use it as support. Well, one day later, you can see we've got a bounce higher here today, giving us the impression that maybe market participants want to use that 30-day moving average as a support bounce or a support launch area. You could probably even draw a trend line that was broken somewhat here today as well, right? There's that kind of that nearer term downtrend line that you see that has been kind of controlling price action for the last 2.5 weeks that today we were able to get above and out from. Now, the one thing I don't necessarily like about the trade is that we did not close at the highs of the day. So we had a little bit of a pullback there at the end of the day. I hope that doesn't spell doom for this trade going forward. Nonetheless, I do like that breakout of that downward diagonal trend line that I have there, in addition to finding the support level where I would assume that it would show up, which is right at that rising 30-day moving average. So this was a 1-for-1 reward risk trade relationship. So it's set up as a bracket order. Again, trade details for those of you that are premium members in the Telegram app there. But you can see this now has a bullish near-term posture here, and that near-term line is that blue line down below. So we'll see how that plays out and see if maybe some of those utilities can keep on chugging along to the upside there, as we found some nice bullish market conditions here recently. So that's what I had for you here for the night. I thank you for tuning in. If you got value out of this video, click like for me there on Twitter, and I hope to see you on Thursday. Take care, everybody. Bye-bye.